Hello, I'm Mary Reed, National Director of Qualified Plan Marketing for Alliance Benefit Group Pentegra. We are a third-party administrator of qualified plans and currently administer about 3,500 plans. Our parent company, Pentegra Services, Inc., has been in the pension business for nearly 70 years. Together, our expertise and talented staff helps find solutions for clients. Welcome to our training series for financial professionals. In this series, we will use our expertise to help prepare you to find prospects and write qualified plans from closing to establishing the plan and further administration. Let's begin. Welcome to our session on defined benefit plans, a plan that's near and dear to my heart. I'm a big believer in defined benefit plans, and hopefully you will be too when we finish this. So let's talk about retirement. How much do you think you need to retire? Is $500,000 enough? $1 million? $2 million? $3 million? $30 million? What percentage of current income? These answers are not so easy to come by, and they're certainly not the same for everyone. It depends on the lifestyle that person wants to live, as well as a lot of other factors. But one thing that most people can agree on is that typically people don't have enough money put away for retirement. A defined benefit plan is a great tool for business owners who have cash flow, probably profitable, have had the money, but maybe they haven't been too good about saving for their retirement. And retirement isn't that far away. Maybe they didn't think about it very early. Maybe they are now saying, I want to retire in 5 years or 6 years or 7 years or 3 years, heaven forbid. A defined benefit plan is a tool that can help them accumulate a substantial sum of money in a short period of time. Unlike a defined contribution plan, which limits the contribution to $50,000 in a year, defined benefit plans are funding to a promised benefit that could be as high as a lump sum of in excess of $2 million. And the amount that has to be put in each year will be whatever is actuarially required to get there. And if that employer has the cash flow to make that happen, this could be a great tool to help them achieve that goal. Also, it brings some certainty into the business owner's world because unlike any kind of defined contribution scenario where we know what we're putting in, but we don't know what we're getting at the end, here we know exactly what we're going to get at the end, assuming that employer keeps up with their contribution. Also, the plan can be set up to have guaranteed returns. If they want to take all the risk out of it, it all can be guaranteed. That's a choice they can make. Could also have guaranteed death benefits if they want that in the plan. Costs can be set up so they are very predictable. The plan has protection from creditors, so long as they have one rank and file employee in there, and they get a current income deduction for everything they put in. All great value, all provide some certainty. Those are known factors. But the question is, at what cost? At what cost? Can we afford it? And that will depend on how the numbers play out for that employer, and we'll come around to that. There is also a great advantage here for baby boomers because it is the only plan that will allow older employers, their employees in their company, but older participants to accumulate large sums in a shorter amount of time. There's just no way if you're doing a profit-sharing plan of 401k, and the most you can put in is $50,000, maybe $55,500, the $55,500 if you have the catch-up, but you can only grow that money so fast. And if you're, let's say, within 10 years of retirement, you're just not going to be able to accumulate that much. Whereas here, if you're within 10 years of retirement, you can put in much larger amounts and end up with much larger savings. So let's take a look at how much more. On slide 6, you can see we have someone here who's 55 going to retire at 65. In the profit sharing plan, they could put away their $50,000. If it had a 401k feature, they could pick up the catch up as well. But in the defined benefit plan, funding for the maximum benefit, the actuary does their calculations and the maximum contribution is over $137,000. Much larger contribution. Now, what does that mean for their retirement? Well, in 10 years, we grew the profit-sharing plan at 5%, an assumption they would have just under $740,000 if they earn that 5%. We don't really know what they're going to earn, but if they got 5%. But the defined benefit plan, they would have accumulated a lump sum of over $2.2 million. And that is a fixed number. It floats somewhat with the interest rates, but that's a conversion of the maximum annual benefit limit, converting that into a lump sum, so we know it's going to be a very large amount and they know that money will be there. There are different types of defined benefit plans. There's the traditional that's been around for so many years. These come in two varieties. One's called Safe Harbor. That would be a very straightforward defined benefit. I'm sure you've seen these along the way. And then something called General Tested. It just means that the actuary has more flexibility in how they do the testing and we can get a little more leveraging in the money. What it means ultimately is if we have a slightly larger group, we could have more than one benefit formula in that plan with different employees under different formulas, and so long as we pass all our discrimination testing under this general tested method, the plan will pass. Gives us more flexibility. Fully insureds, these used to be the 412Is, they're now 412E3, and then cash balance, which is really a hybrid plan. It's a defined benefit plan that looks very much like a defined contribution plan. They're pretty new out there in the marketplace, but they have been taking off and gaining in popularity. So how much can we put in? Well, here are the benefit limits that apply. The maximum annual benefit we can fund to will be the lesser of 100% of pay, taking the 3 consecutive year average, or a benefit of $200,000 payable as a life annuity. That would be payable sometime between ages 62 and 65. That's below 62, it gets reduced. Beyond 65, it may get increased, but a $200,000 life annuity, $200,000 a year. What the contribution is for that depends on how old the person is and how many years they have to accumulate the money to pay that benefit. So there's no specific contribution limit. It will be whatever the actuary determines. There is a maximum compensation in the qualified plans that we're allowed to recognize. That's $250,000 this year. That pretty much applies to all the plans. So they might be making $500,000, but we can only recognize $250,000. So how much will the contribution actually be? Well, it depends on what their entry age is and what their retirement age is and how many years of service they have and what's their average compensation. And this will be different for everybody. So we have to run the numbers for each specific case to answer that question. Now, one of the concerns that business owners are going into defined benefit plans is this is a commitment. This is not like a profit-sharing plan. This is a commitment. You have to contribute every year. You must. And there are ways to control that. We don't want to get to the end of the year and then find out that the employer doesn't have any money. We want to communicate with them throughout the year to make sure that the plan is okay. But if they're having a rough year, there are ways to kind of back off the plan to reduce that obligation. We could reduce the formula to cut back so they don't have to fund as high a formula, so that would reduce the pressure on them to contribute. We could, if it's a fully insured plan, we could convert it to a traditional profit sharing. That also would reduce the contributions. And if worse comes to worse, if their business situation has really turned dire, we can always terminate the plan. Now, as I said, there is an obligation here. There are minimum funding requirements that must be met. Generally, it's annual contributions. The actuary will calculate that every year. They do have up until they file their tax return to actually make the contribution for the prior year, but cannot go beyond 8.5 months when the plan year ended. So if their plan year ended December 31, 8.5 months, September 15th would be the time they have to make their contributions by in the coming year. If they file their tax return sooner, it has to be before they file their tax return. Including any interest that they might owe if the plan is subject to quarterly payments. Not all plans are. And there are penalties if they don't meet their minimum funding requirements. The IRS is very serious about this, and it's not an easy thing to escape. Now, there's the Pension Benefit Guarantee Corporation. It's a government organization created in 1974 to guarantee benefits and defined benefit plans for employees. It doesn't guarantee all the benefits. There are certain minimums. Right now, the maximum, to give an example, that it would protect is a monthly benefit of $4,654 for someone who's age 65 in 2012. But it does guarantee some benefits, and there are premiums that have to be paid. The plan, if the plan is fully funded, adequately funded, those premiums are not very high. If the plan is underfunded, they do go much higher. But it is unavoidable. It has to be paid if you have a plan that comes under the PBGC, but that's not such a terrible thing. Now, enhanced benefits. You can also, in a defined benefit plan, add life insurance. This is allowable. And it's a pretty common practice because it's a very cheap place to buy the insurance. All the premiums will be paid with pre-tax dollars because they're paid out of plan contributions. And it also makes the plan self-completing. If you have someone who's really planning on having that $2 million plus for their retirement, if something unfortunate should happen along the way and they don't get to finish funding it, it will not all be there, and perhaps they're leaving someone behind who needs that money. Putting life insurance in the plan can guarantee, whether they make it or not, that money is going to be there. The death benefit, the pure death benefit from any life insurance policy in a plan will be paid income tax free. And assuming they don't die and they make it to retirement, they can take that policy with them if they want to continue it. It's permanent insurance. Here's the reason so many employers will do this. Here I have a 55-year-old funding to age 65. They're going to have $2.2 million when they reach age 65. With no insurance in the plan, the actuary calculates the contribution is $137,358. Well, we put $1 million of insurance in here for this participant, and yes, there's an additional contribution because we can't eat away at the promised benefit. They're still going to get their $2.2 million. So now the plan contribution is $138,000, all deductible. Sometimes that's what employers want. They want the bigger deduction. Now, it increased, you can see on slide 16, it increased the plan contribution $642. All of that is deductible. So take about a third of that off for tax savings that they get back in return. So out of pocket, it's costing them maybe $450. But the premiums for this policy, this is a permanent policy, a whole life policy, were actually $28,600. Now imagine if they bought that insurance personally because they had a need outside the plan, they would have to gross earnings, pay the taxes to net the $28,600 to pay for it. Here, they just had to up their plan contribution $642, which was deductible. So out of pocket is costing them $400 and change to get that same coverage. Very cost-effective place to buy the coverage when you need it. There are always incidental limits. I'm not going to spend a lot of time on them, but you cannot have all the money going to insurance. There are limits. Typically, we use Revenue Ruling 74307, which says that if we're using universal life, which you can in a defined benefit plan, you calculate the contribution to the plan without insurance in a specific way. You could take up to 1/3 of that amount and spend it on premium, 2/3 if you're using whole life. The actuary will make all those calculations for you. You don't have to worry about that. When life insurance is in the plan, it provides death benefits right from day one. And the policy surrender values are partially funding the retirement benefit. That participant obviously can always, when they retire, decide whether they don't want to keep the insurance, it could be surrendered. They can keep it and take it with them as well. So let's look at a case study. I've got 2 owners making $250,000 and 2 employees here. One's age 32 and one's age 62. How would a plan play out for them? Well, if we did a traditional defined benefit plan without the insurance, you can see the contribution for this plan is $270,255, of which 90% is going to our 2 owners. Now, one owner is older than the other, and age is a factor here. So the contribution for our older owner is $188,111. Our younger owner, it's $56,618. They may or may not be happy about that. If they weren't, we could play around with the contributions, and we'd have to cut back the older owner. We could not get the number higher for the younger owner. If they decided to put life insurance in this plan, the contribution would go up to $288,299, 91% for the 2 owners. And you can see the 61-year-old would have $2.8 million of life insurance. The younger owner would have 2.5, almost 2.6 million of life insurance protection. The employees get protection too, because when you put life insurance into a defined benefit plan, all the employees have to be covered, so they would get insurance as well. So which clients might be a candidate for this? Well, defined benefit plans are rich. They do require substantial contributions to make it worthwhile. So you're looking for clients who are profitable and they have the cash flow to be able to do this. They're probably interested in saving taxes, might want the protection from creditors. They might be wanting and have a need to save for retirement and have that be an appealing feature for them. If they have a current plan, perhaps it could be improved by improving the design, or maybe they have a profit sharing plan and they would like to layer this on top. and have both plans going for them. That's a scenario that people who have a lot of cash flow to work with are very attracted to. And they also may be interested in finding a place and using the plan as a place to pay for life insurance they might otherwise be paying for or have a need for. What do we want to know from the employer to find out whether this will work for them? We need census for all the employees, dates of hire, dates of birth, and salary. And then we want to know from the employer, how much do you want to contribute? How much can you afford to contribute? Who would you like to include and who would you like to favor? And from that information, we can put together a plan design and start to run some numbers and see what might work for them. Now, if they like the plan, then what would the next steps be? They need a plan document to establish the plan, and they need to be aware if they want this plan in place, just like any other qualified plan, they want a deduction this year, they have to sign that document by December 31. Depending on how sophisticated and how complex that plan design has gotten, we may need to do a custom document, which means a few weeks to get that document ready. And then they sign it, and then they're ready to go from there. The plan has to have ongoing administration. An enrolled actuary has to sign the Schedule B that goes with the 5500. And we provide all those services. So if you have a client who might be a potential candidate and you might be interested, just give us a call. We'll be happy to talk it through with you and see whether it might work for them. If you'd like additional information, please visit our website at abgpentegra.com. You can also reach me via email at mread, that's R-E-A-D, like you read a book, at abgpentegra.com, or you can call me at 802-477-2018. Thank you.